Hi there, this is Roger Otten again for the course Institutional Investors, and I would like to share with you the final reflections on week 6 and 7. And as I said before, hopefully this is helpful in preparing for the exam. So what did we see in week 6? So in that particular week we talked about responsible investing. And more importantly, we saw that ESG investing, which means incorporating environmental, social, and governance criteria in your selection process, is gaining in importance among institutional investors. So for instance, on the right-hand side, you see a small graph which shows that over time, more and more institutional investors have actually embraced ESG, just looking at the sheer numbers. But you also see that there's clearly several institutional investors involved. So although during the course we talked a lot about pension funds, which would be the public funds on the right, it's also clear that insurance companies form an important, let's say, part of this universe of institutional investors. And also they are taking this much more seriously. During that week, we talked about why that is the case. And we identified several drivers. First of all, regulation is shaping up. So more and more local regulators are asking investors, and more in particular institutional investors, because they invest on behalf of other people, it's not their own money, to be more transparent. So more and more regulation is coming up to be transparent on how you include ESG criteria, which doesn't mean you have to include them, but you have to be transparent. Most prominently, there's an EU taxonomy, which is also referred to as the Green Investing Taxonomy, that prescribes that institutional investors have to be transparent on ESG. After that, of course, supervisors will take a closer look at this. So do investors indeed provide transparency on this? On top of that, there's client interest. So as I said before, as an institutional investor, you invest on behalf of your clients. And more clients are asking for this. So there's a clear demand and interest by the clients of institutional investors. And finally, society. So this could be your typical NGO, but also society at large, which is questioning current investment practices by institutional investors. And all of this together leads to more interest in ESG investing by our so-called institutional investors. A very important topic that we discussed in week 6 is whether this is a violation of fiduciary duty. Now, what was that again? The idea is that institutional investors invest other people's money. That means you have a duty, a so-called fiduciary duty, to invest in a way that protects the interests of your clients, which is also called a so-called prudent person. You have to be a prudent person with other people's money. So far, this has typically been described as you cannot invest in a particular portfolio or asset if you know upfront it leads to a lower return or higher risk. So the question now is ESG investing a violation of fiduciary duty? To put it differently, does it cost money? In week 6, we established, based on a very large meta study by Bassen et al., they looked at more than 2,000 academic studies, and the main conclusion from the Bassen study that we discussed is that the overwhelming majority, 80 to 90% of the studies investigated, find that ESG investing leads at least to a similar return and sometimes even a slightly higher return. So an important conclusion from week 6 is that ESG investing is not a violation of fiduciary duty. And this was very important because it did support institutional investors moving into ESG investing, because there is now sound academic evidence that you can do this without actually getting a lower return. So that was the most important conclusion from week 6. Then we move to second part of week 6. So we had the Monday we had on fiduciary duty, and Wednesday we talked about one of the tools that you can use to implement ESG investing. And we specifically talked about so-called active ownership. Now, what does active ownership mean? It means that you, as a owner of a company, and if you own a share, you are a partial owner of the company. you can be active. And we've seen, for instance, that institutional investors, so the abbreviation here is II, they use their influence on companies to actually improve the ENS scores. I put G in brackets because the article by Dijk et al. Mainly talk about improving ENS scores in a company. So institutional investors use their influence, among others by engagement, among others by voting, to actually change company scores on ENS. Why do they do that? Among others, they do that for risk management purposes. And what they, for instance, find is that during a crisis, companies that score higher on ENS are more resilient to withstand this crisis. So institutional investors believe that improving ENS leads to a more stable company and hence see this as a risk management tool. In addition to that, Dijk et al. Talk about reputation risk, which is straightforward, but also morals, which of course in this case are less important, I would say, compared to risk management and reputation, because morals is very difficult to put in numbers. Still, these are three reasons that Dijk et al. Identify why why investors involve an influence in companies on ENS. Secondly, we looked at the article by Kruger et al., which was a survey article. And what they find is if they talk to institutional investors, indeed, many of them use active ownership, which we also call engagement, to actually influence company behavior. And one of the most important factors that institutional investors focus on is climate risk, according to Kruger et al. Why do they do that? Because they think it either has a financial impact. If a company is not managing climate risk in a proper way, it might be detrimental to risk and return of the investment. Secondly, for regulatory risk, which I think is also obvious, as soon when regulation on climate risk increases, this could also have a negative impact on company earnings. And finally, reputation, which also in this case is a driver for considering climate risk in a portfolio. What they then did, they surveyed investors on, okay, how do you actually use this influence? And then we talked about two different ways to exert your influence as an active owner. Either via engagement, which we discussed in detail in Dijk and Kruger et al., which means that you try to change a company from within. So you stay invested and you try to change the company rules, policies, and behavior. The other side of that actually is called divestment. And divestment just means you don't try to change the company anymore, but you sell your shares. And by divesting, that means you're out. And we talked about the pros and cons a bit. And what we then saw is that based on Kruger et al., we see that the majority of institutional investors actually decide to stay in. So most investors try to influence companies when it comes down to climate risk by staying in and engaging and making companies change. However, we also talked about the carrot and the stick in some sense. So the carrot would be that you stay invested and you engage to actually improve. But in the end, if the carrot doesn't make the company move sufficiently, you use the stick and then you divest. There's some disadvantages to divestment, because if you divest, of course, you lose your impact and your influence. You have no seat at the table anymore. And finally, it also means that maybe other investors take over your shares and they might not have the same ESG goals. So divestment is not to be used lightly. That's why most institutional investors surveyed by Kruger actually say we prefer engagement. Still, having said that, several investors more recently have decided to use the stick. And among others, as I'm sure you discussed in your tutorial groups, my pension fund, the pension fund that I work for, ABP, decided to use the stick on fossil companies. And the main reason for that is because engagement turned out to be not yielding the results that we were hoping for. And by using the stick, you hope still in the end to change company behavior. Again, based on Kruger, most investors stay in until a certain point when change is not happening and you could divest. Then we move to week 7, we had a guest lecture by Professor Bauer, and he took the company perspective. So while during the course we mainly looked at the investor side, he then shared his views on how companies actually interact with investors on this. And he showed that it's important to, first of all, establish corporate purpose. And as soon when you have established that, you have to connect that with strategic goals of the company. And he also provided some further readings on that, many links in his presentation. Among others, there's a great book by Alex Edmonds, which is called Growing the Pie, and he shows how corporate purpose does influence risk and return of companies. Secondly, he also made a case for empowering shareholders. So if there's a sound corporate purpose and a sound corporate governance, then you should also empower shareholders to get into engagement with companies to have a sound strategy going forward. So he kind of gave a different perspective on how we look at ESG and how we look at corporate sustainability from the company point of view. Then on Wednesday, we wrapped it all up with an assignment. And again, we came back to the University Professors Pension Fund, and we had 3 teams advising the board on what to do with responsible investing. One group had to talk about best in class or positive screening. And I think it's fair to say that this group, of course, had the momentum because ESG investing is on the rise. We've seen that the majority of studies show it doesn't lead to lower returns. They even indicate that in many cases the risk is lower. So if you have the same return but a lower risk, you have an improved risk-return trade-off. So it's obvious that many investors are going in this direction. Secondly, there was a team which had an interesting assignment who had to plead for the opposite. So you would go for so-called sin stocks, which would be the opposite to some extent of high ESG stocks. Although you could debate that, but that's how we put it in the case. Interestingly, what we've seen there is that a lot of investors actually are so-called shunning sin stocks, which means that they don't invest them. And by doing that, you could perhaps see that the cost of capital of these sin stocks might go up. To still seduce investors into their company, they might need to pay a higher cost of capital. That would then probably also lead to higher return for the investors who still want to invest in sin stocks. Actually, if you look at real life portfolios, and one of them is the so-called Vice Fund, that's not the case. If you look at longer horizons, if you look at more recent data, you see that a portfolio of sin stocks, net of transaction costs and turnover, all these real life restrictions, doesn't even lead to a higher return. So that's why this is not a very popular investment strategy. Finally, in the assignment, we took a look at ESG for real estate. And so on week 5, we talked about real estate as an investment. Actually, it was week 4. And then we saw that many investors are allocating to it. But now we intersect this with ESG. And we saw that ESG for real estate is very material. Even if you look at all the asset classes that investors invest in, for real estate, the link between ESG and financial returns is most material. So for instance, buildings which have high ESG scores, they have higher rents. That's good if you are, of course, the owner. They have higher transaction prices and they have lower vacancies. Secondly, this is also fueled by regulation. So in more and more countries, buildings need to have a certain label. On the right-hand side, you see some colors. I guess you know them from your home appliances, but this also holds for buildings. And if buildings don't have a specific label or certification, you cannot even rent them out. And research has shown that buildings actually who have a higher label also have a better return. So this is a no-brainer, ESG for real estate. Investors are closely monitoring this and have developed tools to actually benchmark this. And one of the tools that investors use is the so-called Global Real Asset Sustainability Benchmark, abbreviated as GRESB, and this was actually set up at Maastricht University by my colleagues. So that was week 7. Then, of course, as you know me by now, I come back to the upside down triangle. And by looking at this triangle, I'll try to wrap up the course for you in a couple of minutes. So the course is called Institutional Investors. And what we did throughout these 7 weeks we simulated the investment process of an institutional investor. Now, how do we do that? We started on top, which means we look at so-called asset liability management. Very important, we always start as an institutional investor with what's my goal? What is my purpose for being an investor? And typically a goal for an insurance company would be to be there if a policyholder gets paid out his policy, and if you're a pension fund, you need to pay out future pensions. So you need your goal, your long-term goal, which would be your liability. For pension funds, we also saw that calculating this liability can be tricky, and for that you need a very appropriate discount rate. And we discussed that in some countries people have used discount rates which are too high, which makes the picture more rosy than you actually have if you would use a more proper discount rate, which would be more like a risk-free rate. So we looked at liabilities and we looked at how to discount them to the current using an appropriate discount rate. That's still at the ALM level. Then we talked at different systems of how to actually pension funds can be organized. And we looked at two main systems. So you have your three pillars. You have your state, occupational, and your private. And then we looked at the second pillar, which was the occupational pension. And we analyzed that changes have taken place. So while a couple of decades ago, the defined benefit system was the major system within the second pillar, this is now changing into a new system called defined contribution. And that's happening because companies are shifting their responsibilities to the employees of bearing the investment risk. Then we went down one level, we went to strategic asset allocation, which means as soon as you know your liabilities, you need to make sure you invest in assets which enable you to meet your long-term liabilities. We found out that the horizon is very important. And we saw, based on the article by Luis Ficera, that the investment horizon determines how you invest. So the longer your investment horizon, the more risk you can take. And why can we do that? Because in the long run, the risk of, for instance, equity becomes smaller because of time diversification. So in the second layer, strategic asset allocation, you determine where to put the money, and we saw that the investment horizon has an important impact. Then we went down and we said, okay, if we now know how much to invest in which asset class, how do we actually go about that? And we talked about costs, and we talked about active and passive management. And we realized that a clear shift is taking place among institutional investors. And the shift being that institutional investors are making different groups of investments, of asset classes, where the more efficient asset classes, where it's difficult to beat the benchmark, are being managed passively, so buying trackers, buying ETFs. And on the other hand, asset classes where they still think they can beat the market, which we would call inefficient markets, are still being invested actively. And this led to a concept called core satellite, where you have a core of assets that you manage passively, and you have satellites of investments that you invest actively. As an example, we talked about several of these satellites in the course. We talked about private equity, we talked about real estate, and we talked about infrastructure. These are all satellite investments which you obviously invest in actively because it enables you to beat the market. Then we went down to the final part of the course where we talk about security selection, which stocks to buy, and of course also to trade. And we talked about responsible investing, which I just wrapped up with you a minute ago. Again, the big picture there is that ESG investing does not violate fiduciary duty. We see more and more investors moving in that direction, which means they screen portfolios and they act as an active owner. So that brings me to the end of this course. I really hope you enjoyed my attempt at simulating the actual investment process from an institutional investor point of view. I hope you also appreciated these reflection lectures, and I wish you all the best for the exam. So, work hard, and I'm sure you will do fine in the exam. And, after that, happy holiday season and a very good start to the new year. Thanks a lot. Bye bye.